Welcome to The Explainer. Today, we're unpacking a concept that can completely change the trajectory of how you build wealth. And the best part, it does it quietly. We're diving into Ramit Sei's insights on automated investing. If you are totally exhausted by the narrative that growing your money means sacrificing your peace of mind to constantly pick winning stocks, let's explore a system that practically runs itself.
Okay, let's dive right into this. Think investing requires picking the next Apple or Tesla? Yeah, when most of us hear the word investing, our brains immediately picture a really stressful, high-stakes game. We're told we need to scour the market, find the next tech giant, and time everything perfectly. But as the data shows, treating investing like a 24-hour news cycle isn't just exhausting, it's actually dangerous to your portfolio.
Here is our clear step-by-step roadmap for today. First, the stock picking myth. Then, what automated investing is, the hidden wealth killers, 7 steps to automate, the robo-advisor question, and finally, your wealth action plan. Let's get to it.
The stock picking myth.
We really have to address the elephant in the room right off the bat. 90%. Studies show that a staggering 90% of people who try to time the market actually end up losing money. No way, right? But it's true. So look, if you've been avoiding picking individual stocks because, honestly, it feels a bit like gambling at a casino, your instincts are totally spot on. Jumping in and out based on daily headlines is quite literally a statistically losing game.
Section 2. What automated investing is.
So what's the fix? Well, the alternative to stock picking is actually remarkably boring, which, believe it or not, is exactly why it works so incredibly well. You just buy consistently, regardless of whether the market is way up or way down. And the absolute best tool for this is probably one you're already somewhat familiar with, an index fund. It's just a simple fund that owns tiny pieces of hundreds or thousands of major companies all at once. Instead of stressing over whether Google or Microsoft is having a better week, you're just buying a tiny slice of the entire US economy. It lets your wealth grow right alongside the economy, completely hands-off.
Let's actually look at the math in action, because this is where it gets really fun. Say you're bringing home $4,000 a month, and you automate a $400 investment on the 15th of every single month. Over 10 years, you'll have contributed $48,000 of your own hard-earned cash. But thanks to the magic of compound growth, your account value could actually be worth over $65,000. To put that into perspective, that is massive growth happening entirely in the background while you're just out there sleeping, working, and living your life.
Section 3. The hidden wealth killers.
Now, even well-meaning folks who try to manage things manually often fall victim to these silent destroyers that just eat away at all that beautiful compound growth. There are 3 big ones you've got to watch out for. First up, expensive fees. A lot of mutual funds charge 1 to 2% in annual fees. Now, I know 1% sounds tiny, right? But over your lifetime, that 1% can literally rob you of hundreds of thousands of dollars compared to low-cost index funds. Seriously, hundreds of thousands. Second is frequent trading. Constantly buying and selling triggers tax bills and transaction fees that can gobble up another 2 to 3% of your returns every single year. And third, emotional decisions. You know, buying high during the hype and selling low during a panic. Our brains are just wired that way. But automation mathematically protects you from your own worst instincts.
Section 4. 7 steps to automate. Now, what's really interesting about this next part is how easy it is to actually execute. Let's move from theory into action and get your system built. Here are the first 3 steps. Step 1. Literally just take 15 minutes and open a free account with a trusted institution. We're talking places like Vanguard, Fidelity, or Schwab. Step 2. Understand you want broad index exposure, something like the S&P 500. And step 3. Choose one simple fund, like a target date 2065 fund, or whatever year ties to your retirement. The absolute golden rule here: make sure your expense ratio is under 0.20%. That basically means you're paying less than $2 a year for every $1,000 you have invested. Dirt cheap.
Moving right along to the final 4 steps to put the whole shebang on autopilot. Step 4. Decide your monthly amount. A great benchmark is aiming to invest 20% of your take-home pay. But hey, if you need to start with just $50 a month, just start. Step 5. Set up automatic paycheck transfers. You can actually ask your HR department about direct deposit splitting, or just set up an automatic bank transfer for the day after you get paid so you never even see the money. Out of sight, out of mind. Step 6 is absolutely critical. Automate the actual fund purchases inside your account so your cash doesn't just sit there doing nothing. And finally, step 7, schedule a quarterly review. Don't look at it every day. Just check it every 3 months to make sure things are running smoothly or to bump up your contribution if you got a raise.
Section 5.
the robo-advisor question.
As you're setting this up, you might be wondering about algorithm-based services like Betterment, Wealthfront, or Schwab Intelligent Portfolios. These are robo-advisors, and they build and manage a portfolio automatically for a small fee, usually somewhere around 0.25 to 0.50%. They are honestly great if you have balances over $50,000 or if you just want completely hands-off tax loss harvesting. However, the do-it-yourself approach, which is just buying a single target date fund as a beginner, gets you like 90% of those exact same benefits, and it saves you tens of thousands of dollars in fees over the long haul. So it's definitely something to weigh.
Section 6, your wealth action plan.
Okay, we have covered a lot of ground today, so let's figure out if this boring is better system actually fits your specific life situation. Automated investing is an absolutely perfect fit if you have at least a 10-year timeline before you actually need to touch the money and you have a steady income to support those consistent monthly contributions. On the flip side, if you need this cash in under 5 years, you need a different approach. Keep it safe in high-yield savings accounts or CDs. And if your income is super variable or unstable, actually, scratch that. No matter what, your absolute first priority before even touching the stock market needs to be building up a solid cash emergency fund.
I really want to leave you with this incredibly powerful thought from the source material. The true benefit of automated investing isn't just financial gain, it's the freedom it gives you. And this hits the nail right on the head. This is what it's all about. By setting this plan on autopilot, you are literally buying back your time, your energy, and your peace of mind. You aren't obsessing over daily market fluctuations. Instead, you're freeing yourself up to advance your career, hang out with your friends and family, and just live a richer life, knowing with absolute certainty that your money is quietly working for you in the background.
So I have one final question for you to consider as we wrap up this explainer. Will you continue to stress over the daily market swings, constantly trying to guess what the future holds? Or are you ready to take just 15 minutes, follow these simple steps, and put your wealth on autopilot starting today? The choice is entirely yours, but I think we both know which one leads to a richer, much more peaceful life. Thank you so much for joining us today. Get out there, automate those investments, and take full control of your financial future.